Hey everybody, this is your girl Cheryle, and this week's Till Talk is I have Anastasia, your Loan Queen, and we're going to be talking about why not wait. Is the why?
Why waiting is not the answer.
See, there you go. You go ahead. You take it away, Anastasia. With how does that work?
Yeah, so I mean, what we do is essentially, if a home has been sitting on the market for a little bit, usually longer than 30 days, what we can do is encourage the seller of the home to potentially give the buyer a credit towards either their financing or closing costs. So there are limits to those credits, but it could be for conventional financing, actually up to 6% of the purchase price can be in a form of a seller credit. And so you can actually pay, again, all of your closing costs and even buy down your rate, which is a temporary buy down. So those are also some of the things that technique we use in order to make it more affordable for home buyers.
Temporary buy down. So how long is it the range?
It's a good question. So I have 3 different products for temporary buy downs. Again, what that means is a seller is giving you a credit towards buyer's financing for a short period of time. We have a 1-0, a 2-1, and a 3-2-1 buy down. I'm going to talk about the most popular one, which is the 2-1 buy down. A 2-1 buy down means that the interest rate for the buyer is affected for the first 2 years of their loan. So it's not actually, it has nothing to do with whether it's fixed or an ARM. A lot of people get really scared when they talk about ARMs because they think about balloon payments and it's then they have nightmares from 2008. So this is actually, again, to make it more affordable for the first couple of years in somebody's, home purchase. So again, if you have, let's say a scenario, if you have a husband and wife and the wife is a stay-at-home mom and right now only the husband is on the loan, but you expect the mom to go back to work in the next couple of years. So what you do is you ask for this 2-1 buy down, makes it more affordable for those mortgage payments because it's a 2% reduction in rate for the first year, 1% reduction in rate the second year. Roughly, it's about 2.5% of the purchase price. That's roughly the credit that the seller would provide to the buyer. So on $1 million purchase, it's roughly $20,000 of a credit, and which actually affects the buyer's mortgage payments almost $1,000 a month for the first year and about $600 a month the second year. Much, much more effect than if you have a $20,000 reduction in price, which then affects the buyer maybe $50, $60. I mean, it's insignificant. But because it's amortized over 30 years, the credit is not as effective. So highly definitely recommend looking at temporary buy downs. This credit is kind of, the market dictates when we use this credit or not. The one thing is, right now is a perfect time for these temporary credits because the interest rates are elevated. So if we're going in and if we can get an interest rate right now of 6.125%, imagine if you can now get an interest rate of 4.125. Now we're back in the fours, right? Back in the fours like we were earlier last year. And depending on your FICO and your credit score, you can actually buy down your rate in addition to this temporary buy down, so you can be back in the 3s. And so it makes it much more affordable these days for using these credits. Tell me a little bit about what you're seeing in terms of the amount of inventory available. Because I know last year it was kind of, it was challenging. We're low in inventory. So I was just curious as to what you've seen in the market now.
It's picking up because, yes, after the holidays, it's always low. People don't want to do anything during the holidays. So, yes, this January it has picked up significantly. I'm seeing more open houses. We're doing more open houses. Yeah. So this month it's definitely picked up, and I know it's just going to start picking up more because we're just getting out of the holiday season, and so everything's picking back up. So I don't see anything wrong, and people are getting so scared and
right.
not and waiting or whatever. Why wait? There's no specific time to buy a house. I talk to people all the time and they're like, gonna wait for the perfect time. I gotta wait for this and I gotta wait for that. And there's no perfect time to buy a home.
Yeah.
You get it now. If you have funds available or you have access and you have good credit, why wait?
Yeah. No, and definitely. So it's not timing the market, it's time in market. That's
Right.
like one of the most popular slogans that realtors use is if you have an objective to have your real estate for at least 5 to 10 years, you have a plan, you have a family, and you think you're going to stay in a particular city for at least a few years, buying versus renting, it always makes sense to buy, only through appreciation and equity. And then one of the things is, how do you know you're ready, right? That's a good question to kind of address here is when do you know you're ready? Because sometimes I do a lot of home buyer consultations, and what I encounter a lot is buyers that think they're not ready when they have been ready for years. So that's an opportunity loss right there. You think you're not ready, and here you are. You could have already been a homeowner 3 years ago.
Yeah. And that's what happens. You need to talk
Yeah.
to a lender to
Yeah.
see where you are and what else you need to do, or even you can also let them know, plan for maybe for
Exactly.
next year or in 6 months.
Right.
You do these steps, you can be ready in 6 months.
Or, having an opportunity to maybe some portions of your credit needs fixing.
Fix your
Partnering up with
credit.
a lender would allow the lender to take a look at what accounts need fixing. Because, we actually look at credit every single day. I look at reports every single day, and I can determine based on looking at a credit report what items actually make a difference for the actual mortgage application and which items don't. So that's why, it's another advantage of talking to a lender as early as possible. So I have a personal story of mine to share, and this is to do with my own personal finances. In my early 20s, I should have bought a home, and I didn't. It's talking about waiting.
Oh, yes.
When I thought,
Been there, done that.
Exactly. So it's just, I had the opportunity, I had the money, I had a very stable job. And I could have, at that point in my career, in my personal financial journey, I could have probably bought at least a condo, if not 2. And instead, because I, young and dumb or not being informed and not having that education at my fingertips, I passed on the opportunity of being a homeowner early in my career. So now that I'm approaching 40, I could have easily had 10 properties by now if I had taken the advice I'm giving you now. So as long as you have a steady career for at least 2 years and you have at least 5% of the purchase price saved, 5 to 8% would be ideal. So in terms of the figures, if you were to determine how much that would be, for instance, if you're buying something for $1 million, you just need 8% of that. So 5% of that could be the down payment and 3% could be the closing costs. That gives you a rough idea of how much at the very minimum you would need for $1 million, which is, a condo, single family home. It's a very affordable option. Now tell me, Cheryle, in terms of, that your first home doesn't need to be your forever home. I think it's, it's a complete misconception here that, you're looking at those perfect home and you're trying to identify something. And so you can spend a lot of time looking, and because you're psychoanalyzing that in 10 years, this, you might like certain portions of the home.
I know.
So,
People look at
yeah.
people look at homes and they pick every little thing out of it, and they're it doesn't have this and it doesn't have that. If it had this, if it had that, but they have to weigh it out and pick pick something that that they can work with, because it doesn't have to be their forever home. You can say you can live there for 5 years and then find upgrade or downgrade, whichever they want to do. But you really, yes, does not have to be your forever home. You can just, the first thing is what you should think about is getting into a home. Right. Getting into the home, start earning that equity, take that equity and move that to your next home that will make, maybe that will be your perfect home.
Exactly.
Maybe that could be it.
Yeah.
But start somewhere. You have to start.
Right, right. It's just start somewhere. Yeah. No, it's a good point, because I think we get really discouraged. Property values in South Bay are really high because everybody wants to live by the beach, and everybody wants to live in Orange County, and everybody wants to live in San Diego, and all of these coastal towns. They obviously are a lot more expensive than if you were to move to Kansas City or somewhere else. That's
Absolutely.
why, we pay for our views.
That's what we pay for.
And our weather.
This here.
For sure. So tell me a little bit about, besides being ready and having the financials in place, what other questions would you think are important when trying to identify why somebody shouldn't wait? Besides, obviously, if they have a steady job, if they've made the decision to do it, but again, the media is scaring them away from it. So how do they psychologically get in tune with, being ready?
They need to just stop listening to the media. Stop listening to the media. If you're ready, if you have your down payment, closing costs, and you have a realtor and a lender, you should go. There's no need to wait.
Yeah. No, perfect. For sure. And so what would you also say is if somebody can't purchase by where they're renting, what do you think the alternative is? Because perhaps somebody is in a position where they have lofty goals and they want to have an ocean view, and perhaps their budget can't get them the ocean view. So what about, the idea of getting something that maybe is not within your ideal neighborhood to start with for a couple of years?
Absolutely.
And then
start. That's what I'm saying. Start somewhere. Just
Right.
get into something where you can build equity, and then you can move to that oceanfront home or something like.
Yeah.
Because what's the best way for you to earn equity? Like you just said earlier, the $50,000 people that bought last year, their equity is now $56,000. Where else are you going to get $56,000?
Exactly. Right.
So yes, get into something, into a home, get equity. Take that equity and move to their maybe forever home or their perfect home by the ocean, by the beach, one of those coastal areas.
For sure. And so one of the things also we can talk about is at which point do we refinance, or do we refinance? So a couple of opportunities will be coming up next year, talking about the projection of the market. Okay. Historically, we do see a trend that anytime there's a presidential election, the mortgage interest rates actually on purpose get pushed down by the government. Conspiracy or not, they want the public to be happy. They vote for whoever. It has nothing to do with the political party that's in office, but that's a trend to watch. So I can't make any 100% promises, not a fortune teller.
I was going to say, are you telling some fortune that we should know about?
I mean, otherwise I would be the lucky lotto winner from a couple of, weeks ago with the 2.4 billion. So that's one of the things to consider is we are expecting the rates to trend down to about 4.5% towards the mid to end of next year. So if you were to get into a home now, consider those projections. And so again, the interest rates are not high. They're actually average for historical interest rates of real estate. And so one of the things also, again, you're able to refinance next year. So think of if you're getting into a home now, it's going to be a short-term objection here in terms of the mortgage. So if you're paying, if like your current mortgage is going to be $5,000, your mortgage, like in a year from now, is going to be closer to $4,000. So keep that in mind if you are going to be, if the whole point of refinancing. And so refinancing also, it does cost money. So let's put that out there too. It doesn't always make sense to refinance. If you're trying to only save 1/4 to 0.5% off of your rate, probably doesn't make sense to refinance because it does cost money for the actual refinancing process. But if you have at least a 1% difference between your current rate and that's on your mortgage application, on your mortgage note, which is you get those statements in the mail, definitely take a look at all of that. And then whatever is trending currently, it's good to keep in mind all of those. Absolutely. And so next, I think besides the refinancing and cash out refinance would be an alternative too. So in 2 years from now, 3 years from now, you might want to consider cash out refinance. So if the rates are lower, you can actually essentially keep your same mortgage payment, take some equity out. So I think, again, from a financial perspective, that $56,000 that you made year to date, if you would have purchased last year, you can start that habit of, taking it out of one pocket and putting it in the next. Because it's a forced savings. You're paying your mortgage instead of somebody else's.
Absolutely. And just like what you said about, we were talking about the buy down where the interest rates are 6% and they do it for 2 years. You said there was a time frame for 2 years.
Right.
I just think that 2 years, that's when the president thing will be coming on. So that would really work out because by the time your interest rates goes back up, you can refinance.
You can
during that
refinance
time.
and keep those lower payments.
And keep the lower payments.
Yeah,
and you'll
so
continue
November
to
of
have
2024, that's the time to watch.
Yeah.
And ultimately, again, time in the market matters. So buying a home now, you can start to be able to have appreciation and equity going down the line. And so, one of the things also a loan program that I want to mention is if you are short on down payment and closing costs, and maybe perhaps you're a couple in your 30s and you just can't seem to save enough. One of the things you want to maybe consider is if you have any parents that own a home that have a completely paid off mortgage, which many parents did. And I talked to I'm part of Rotary in Redondo Beach, and one of the gentlemen I was talking to for quite a bit.
What you doing in Rotary?
Making connections. I was talking to a gentleman in Rotary, and he was saying, so his first home he purchased in 1964 for $19,000. And back in the day, even though right now $19,000, that's almost like a joke, right? We can't even get a parking space for $19,000. Can't even get a car. Can't even get anything for $19,000. Yeah. But back in the day, for him, based on his income levels, that was a significant amount of money.
Oh, absolutely.
And so what he did to make his level up in his real estate game is, from $19,000, he purchased his next property was $35,000, and from the next time he was $60,000, and then he was $300,000, and now he lives in a property that's $2 million. The whole point is you're constantly upgrading your life.
Absolutely. Yeah.
And so now he's essentially mortgage free. So I discussed with him the option of possibly what we call a home equity conversion mortgage. So it's the old school reverse mortgage, but there's a bad connotation with reverse mortgages, because back in the day what happened is, if we reverse mortgage grandma's home, the bank comes in when grandma dies and takes the home away. So the heirs to that home no longer have access to the home.
Right.
So the program has come really far, and now our reverse mortgages, which is a HECM, home equity conversion mortgage, allows you to go in, and it's a new loan for the home. So whether you have an existing mortgage or not, you can do it regardless. If there's enough equity in the home, you can HECM the home and take the equity out of the home early. So in this situation, if you're a couple in your 30s and you don't have $300,000 saved for a down payment, go in and see if your parents would be willing to do this for you. Because you're going to inherit the house anyways, and you're able to come in, take some of the equity out, and then, unfortunately, when your parents do pass eventually, you would have the opportunity to refinance or keep the home. Keep the home, refinance, or sell the home, just by paying off the mortgage at that time. Mm-hmm. But it's a good program to have, and I think not a lot of people know about it, of, how do you get that down payment money. Yeah. So look into a HECM.
Okay, HECM, okay.
Yeah.
Okay. Yeah, I'm glad they changed that, because that was you hear about those reverse mortgages.
Yeah, it's pretty scary.
Yeah,
it's a lot of predatory lending, and I think that's the difference now. Before in 2007, 2008, and I think everyone keeps talking about that time period, because there was a lot of loan products out there that were completely unethical. Yeah. They were giving people 100% loans. Their debt to income was like at 70%. So they weren't taking into account any of that. And actually, surprisingly, there was no requirements for, the threshold of how to be a loan officer. You pretty much didn't have to take any tests. You didn't have to have a license. It's like scary, right? That's the reason why a lot of people got into mortgage fraud and trouble, is because the threshold of how to get into this industry was exceptionally low. Right. In 2008, they had a new test come up, and it's called the SAFE program. So it's anytime anybody wants to be a lender, it's almost like the bar. It is exceptionally challenging test. And so you do have to have at least a little bit of brain in there to be able to do some math. So they make us do, it's a pretty hard test. So the threshold is much higher for how to become a lender. And so now we're no longer in that position where we have that predatory lending of, and the program's changed too.
That's good. Glad to hear.
Yeah, definitely.
Yeah. Well, thank you, Anastasia, for coming on my show. I love it.
My
Maybe
pleasure.
you can come back again.
I would love that. I would love that.
We can do this again at another time. And this is your girl, Cheryle, and I look forward to seeing you guys on my next video.